Hey, what's up guys? John here. The entire housing market is about to change, and it's going to be reflective with these mortgage rates as most buyers are getting priced out of the market. Just 12 months ago, you could get a 30-year fixed rate mortgage at roughly 3%, but now it's almost impossible to get anything in the 5s or even in the 6s. We're seeing with perfect credit that you could get a 7% 30-year fixed rate. Perfect credit. So much so now that buyers are saying, I must get an adjustable. I may take a riskier loan product, hoping that years down the road, interest rates change and they come down and I can refinance. However, if rates do not change, many of these buyers could be in very big trouble. The average credit score in America is just below 700. So if you have a great credit score, let's say of 720, 715, it's 7.54%. And if you have a credit score like the average American does, it's 698, it's 7.7%. 7.7% for a 30-year fix right now. Now, what does this look like when we're looking at the numbers? A $500,000 home price with $100,000 down. That's a lot of money. But let's say you have $100,000 down and you're going to put 20% down this property. 3% interest rate, it's only $2,671. It's not that bad. I mean, of course, it's expensive. The average rent in America, though, by consideration, is roughly $2,100. So you get the tax benefits. You can write off property taxes. There's many things you can write off with the property, and you can build long-term equity with property ownership. So there's many of upsides and many benefits with this. However, today's mortgage rates, here's what the numbers look like. 7.5%. It's $3,781. That is unbelievable. I'm going to walk you through this. Please hit the like button. Hit the like button. YouTube's going to share this content to educate more people. And if you'd like to make money from home, go to cashnow.video/money. We have hundreds of people already in the community, many of which have already made a lot of money. They're getting paid out every single Friday. No skill, no investment required. We will train you. We'll teach you everything. It's very simple, very easy. It's a copy and paste strategy. And you essentially get to work hand in hand with me and my credit repair company. And you could do so from the comfort of your own home. It's very simple. $3,781. So almost $4,000 a month for a median priced home in America. That is absolutely crazy. Absolutely crazy. The income before, so 12 months ago, on a $500,000 property, you make $85,000 a year. You had monthly debts of about $250, maybe your cell phone bill and maybe outstanding credit card debts. $100,000 down, that would be a $500,000 property. $500,000 property. However, your income would have to go from $85,000 to the same price point. You basically lose $140,000 of purchasing power. $140,000 of purchasing power. So to maintain that $500,000 price point, you would have to go to, even that, $100,000 is still not enough. $120,000, let's see. No, still not enough. Probably $125,000 a year. So you have to make an extra $40,000 a year to be able to buy that same property, right? What is this looking like? It's looking like big problems across America and the housing market coming very, very soon. And now what we're looking at in the UK, is UK mortgage borrowers are in for a nasty shock from soaring rates. London, millions of mortgage borrowers in the UK are bracing themselves for huge hikes to their monthly mortgage payment as a consequence of the run on the pound. Markets have been in turmoil since UK Finance Minister announced the biggest tax cuts in 50 years on Friday, together with a big rise in government borrowing, sending the pound falling to a record low against the US dollar. Some analysts now expect the Bank of England to hike up the borrowing cost to 6% next year, up from about 2.25%, to shore up the currency and convince markets that it's committed to getting inflation under control. It's hard to not draw the conclusion that recent news will require a significant monetary policy response. Hal Pill, the central bank's chief economist, told Barclays International Monetary Policy Forum on Tuesday that markets have already been expecting the central bank to raise rates to 4.75% by next spring. That would have added $201 or $217 to the typical homeowner's monthly payment on an outstanding fixed rate mortgage of $146,000, $157,000. So they're increasing, the cost to borrow is going to go up. The cost of fixed debt is going up. And we're also seeing that some mortgage lenders have been withdrawing rates. So they're already withdrawing applications. Banks are already becoming more risk adverse as they struggle to reprice their mortgages in such a volatile market. Since Friday, lenders have withdrawn more than 350 mortgage products in response to the turmoil, according to MoneyFacts, a financial products comparison website. Halifax, owned by Lloyd Bank, removed some of its mortgage products, while Virgin Money stopped taking mortgage applications from new customers until later this week. On Tuesday, instead of removed mortgages worth 60% and 85% of the property's value for new UK customers and increased rates for new and existing customers from 10 p.m. this evening. Customers who have already applied by this time will not be impacted. Borrowers are worried. Online searches for remortgage more than doubled in the UK on Monday, according to analysts of Google. This is what's happening. So we're going to be stepping into this very unique paradigm shift. What I think we're going to see happen alongside of this will likely be more volatility in the stock market. We'll start to see a lot more people in retirement questioning what the future is going to look like. We're going to see a lot more fear. The last few years, we've seen nothing except meme stock mania and people believing that Tesla is going to go to $10,000 a share immediately. People thought that things were going to just continue to go parabolic. Bitcoin was going to go to 100,000. Everyone was so confident about the market, but now we're seeing a lot less confidence. And I believe that we're going to begin to see more and more people say, you know what? Should I make this investment? Should I do this? Is it really worth it? Can I afford the downside risk if the markets continue to fall? I believe we're going to see that across real estate investors. We're going to see that across home buyers saying, you know what? Maybe I shouldn't buy that brand new house flip. Instead, maybe I should wait, or I'll buy the house in the neighborhood I want to be in, and I'll buy the one that needs work, and I'll fix the property up myself. I'll bring in my brother or my uncle, or I'll save up enough money, and over time, I'll do the work. That's what I think we're going to start to see. We're going to see more of a conservative buyer across the entire economy, whether it be stocks, real estate, everything. We're going to see a lot more fear that's going to be implemented. But inside this, I think there's going to be huge opportunity for smart and savvy investors to make a ton of money because, let's face it, a lot of people are extremely leveraged. And when they're leveraged and the economy turns and everything is getting much more fearful, they begin to sell things. And if they begin to sell at a bigger rate than which buyers are available to purchase, what generally happens is prices continue to fall. And if prices fall, then there becomes opportunity for the smart and savvy investor that has cash, that has a great credit score, that has everything aligned. They're going to be the one that capitalizes. It's going to be the ones that are highly leveraged, that are heavily dependent on a high-paying job to make good on bills. Because Americans, we've had it so good for so long, it looks like this show is about to be over, especially as Jerome Powell continues to increase interest rates. He's talking about hiking again at the next 2 meetings. So if we begin to see interest rates continue to get hiked, what's likely going to happen with that is more and more buyers are going to get priced out of the market. And as that's happening, we're looking at between 1.5 million and 1.7 million new homes that are going to be hitting the market from developers. You're going to start to see a lot more retirees start to list their properties for sale, and a lot more people that miss the market say, you know what, I missed the market. I need to reduce the price. I need to do whatever I have to do to get it in front of the market and sell it. There's going to be more competition, all of which is going to be great, absolutely great news for the patient and savvy investor. And that is what I believe always rewards a great investor, is the one that doesn't run after the deal, the one that knows the price, that knows the value, and that waits for that deal to come to them. They're aggressive with their hunt. They're hunting for the great deal, but they're not going to overpay for the great deal. That's what we've seen with a lot of great investors. Look at Carl Icahn, Sam Zell, a lot of the really smart, savvy real estate investors, people that buy distress. They're the ones that always do well in all markets. It's the ones that are levered, that hope that the market's just going to continue to rise at a 5% or 10%, knowing that the real intrinsic value for the asset that they're buying is not there. They're just hoping that the mania continues. Those investors always get hit hard. They always get hit hard when the market turns. What do you think about this entire situation? Where do you see the market going? I mean, going from a 3% interest rate environment to now a whopping 7%, over 7%, is pretty unbelievable to me. 7.7% for a 680 to 699 credit score. It's that's crazy. This right now 15-year fixed is 6.5%. So on a 30-year fixed, you are looking at, just to show you how accurate this is, 30-year fixed, 700 credit score, 7.54%. 7.54%. Drop your comments below. Let me know your thoughts on this. If you need help fixing your credit score, we would love to help you at cashnow.video. That's cashnow.video if you'd like to fix your credit score. You want great credit when the market turns. Trust me. Go to cashnow.video if you'd like help fixing your credit score. If you'd like help making money online, go to cashnow.video/money. We'd also love to work with you. And Instagram, LinkedIn, TikTok, and Twitter up in the banner. And I'll catch you guys in the next video.